series of online explanatory conversations with domain experts and authorities on specific subjects. I am Monojit Majumdar, editor for explanatory journalism at the Indian Express. Today, we are discussing the union budget that the finance minister presented earlier this month. It was the last full budget of this government before the Lok Sabha election of next year, and the budget underlined what have been the government's broad priorities for some time now: a push for capital expenditure and fiscal consolidation. Changes were also announced in the personal income tax regime. For this evening's discussion, we are honored to have with us here Neelkanth Mishra, India strategist and analyst for Credit Suisse and part-time member of the PM's Economic Advisory Council. Neelkanth has been the expert for several previous editions of Explained.Live, both in its online and in-person versions. He is also a regular columnist for the Indian Express. Neelkanth, thank you for your time. We are very grateful to you. Speaking to Neelkanth will be my colleague and executive editor of the Indian Express, P. Vaidyanathan Iyer. Today's Explained event is brought to you by our partner, Plutus IAS. My thanks to our partner. And thank you all for joining and welcome once again. Vaidi.
Thank you, Manojit. Thanks, Neelkanth, for taking time out of this. Broadly, Neelkanth, even before we get into discussing the budget per se, what do you think were the 3 or 4 things the finance minister would have been occupied with as she was preparing the budget in December and January? What in your mind were the major concerns for the Indian economy?
Yeah, thank you, Manojit and Vaidi. Thank you for inviting me. It's always a pleasure being here. So start with the question. I think the government's role in the economy had to increase substantially during the COVID pandemic and the lockdowns that followed. And it is very important to calibrate the withdrawal, right? So when a government's fiscal deficit goes up, it means that the government is borrowing from the future and spending. Now, when the government borrows from the future, of course, it is borrowing from taxpayers of the future. And so if you consolidate too fast, so as the economy starts to normalize, the government needs to reduce its footprint, slowly start bringing down the fiscal deficit. However, if you consolidate too fast, if the government sort of withdraws too fast, then the economy starts to slow down. So I think that calibration is extremely important. The second big variable is the amount of borrowing that you do from the market, right? So the government before the COVID pandemic used to borrow, 4, 5, 6 lakh crores from the market. Then this number suddenly jumped up to a 10 to 12 lakh crore number because of the pandemic and the excessive spending that the government had to do and some shortfall in tax receipts. So this suddenly creates pressure in the market, right? So if one entity which was borrowing 4 to 6 lakh crores suddenly starts borrowing 10 to 12 lakh crores from the market, where will the money come from? And the RBI could not do the money printing to supply this, which would also have been very inflationary. So how much to borrow? The third important thing is that your numbers need to be very credible. See, remember that this is an extraordinarily volatile situation in the global economy. In fact, while the Indian private sector is starting to recover, Indian consumption is starting to recover, there are still question marks. There are some indicators which are now showing weakness. There are some companies that have reported weak consumption in the December quarter. There is significant uncertainty in the global economy. Remember that the budget that will come out at the end of FY23, the actual budget, will be very different from what was presented in about a year back, in the sense that the expenditure numbers on fertilizer subsidy, expenditure numbers on food subsidy, The tax collection that happened also turned out to be much higher. The nominal GDP growth turned out to be much higher. And I don't think the next 12 months are going to be any different. There will be significant volatility. So how do you present numbers which are reasonable, which are credible, which will not cause disruption in the market? And I'll come to that. That is the fourth point. But also gives you some flexibility that if things get better during the course of the year, then you can adapt to it. If things get worse during the course of the year, you can still adapt to it. And of course, the fourth point was financial stability. Remember that global markets, and including Indian markets, have shown zero patience for policy errors. So sometimes, we think that the fundamentals of the economy drive financial markets, but very often financial markets can also affect the economy. So if there is, suppose, some disbelief in the fiscal numbers and bond yields spike up by 50 basis points, meaning half a percent point, suddenly the cost of borrowing for the overall economy starts to shoot up. And that can slow the economy down. That can create downward spirals. If the economy slows down, the government's tax revenue starts to slow down, and a lot of damage can happen. We saw that happen with the UK, where they announced fiscal policies which were not well thought through. So it was also important, while thinking about the pace of consolidation, the amount of borrowing, the credibility of numbers, to also think about how to keep the economy stable in the presence of significant global economic uncertainty.
Yeah, absolutely. So on all these four counts that you talked about, say on consolidation to stability, what is your assessment, say post February 1, after Nirmala Sitharaman presented the budget? How does the budget look like in these four? Because there was worries that there's going to be the last full budget. There are going to be elections next year, so there were some expectations that there might be many giveaways. There were some in terms of taxation measures where they increased the threshold levels where the income tax kicks in. How do you look at the budget on these counts?
So the numbers are quite credible, right? So I don't think anyone has a problem with a 10.5% nominal GDP growth number. I don't think anyone has much of an issue with the tax collection growth that has been estimated as of now. Right now, it could happen that the economy slows down. It could happen the economy accelerates, and the taxes could go up and down. But as of now, at least from a financial markets perspective, I think these were very reasonable numbers. I think the pace of consolidation, you can quibble about 10, 20 basis points of GDP. So it could have been 5.8 instead of 5.9. But again, the pace of consolidation was not too hot, not too cold, seems very credible. The apprehension that many had was with regard to the quality of expenditure. That will the government sort of give handouts, or will spend on things that have longer term growth multipliers. And so that is definitely a temptation. And if you see some of the political criticism that has come out from the opposition, remember that all of economics is very political. So there is, of course, criticism that this is a khali lifafa, that there's nothing for people here. I think the quality of the expenditure and the fact that the government continues to focus on capital expenditure is very important. That because the size of the government fiscal deficit, the size of government expenditure, is what drives near-term growth. For medium-term growth, I think it is the quality of expenditure that has an impact. So if you have 100 rupees and you sort of hand it over, say you raise the PM Kisan allocation, or you just raise the Narega base rate, the wage rates, or you just announce a cash transfer scheme. So that 100 rupees goes to someone's pocket, they start spending, that creates aggregate demand. It could also create higher inflation. or you can choose to spend that 100 rupees in building a road or expanding or maybe double or triple tracking a railway line. And so initially, all of that creates demand for steel. It may not all be consumption, but it creates demand for steel, creates demand for jobs. And over a period of time, it also brings down logistics costs. India makes India more competitive and therefore supports medium-term growth as well. So on this front as well, at least the government ticks all the boxes. Now, whether they are able to meet these capital expenditure targets or not, whether the 1.3 lakh crores that has been handed over to states for doing capex, whether the states are able to ramp up in time or not, I think time will tell. But the intent of the budget, I think, is very laudable.
Yeah, Neelkanth, one thing on say which you just mentioned while we are speaking on this private investments and expectations of private investments. So in the last 3-4 years, expectedly, the government has been consistent in terms of increasing its capital expenditure. And you can almost see a shift in how expenditure has moved from revenue to capital, like in the sense that, subsidies have come down. Of course, in NREGA, it's a separate welfare expenditure that has also, the allocation is lower this year. So do you see this continuous increase in capex is the right strategy? Private sector is still not coming in. Why do you think that they are still not coming in? So what are the signals that you take from this continuous government expenditure and lack of private sector's interest to invest?
So, I have a bit of disagreement on 2 counts with what you just said and the question that you asked. The first is that, while I think the subsidies, the allocations have come down, remember that fertilizer subsidies are about filling the gap between the market price of fertilizer, urea, and the fixed price at which the government sells it. If the market price comes down, the fertilizer subsidies will come down. It is not that the government's intent is to sort of reduce the allocation. It is just that it is less necessary. Similarly, Narega is a demand-driven scheme. So if more people demand Narega work, I think that 60,000 crores will become 80,000 crores again. It was 89,000 crores in RE in FY23. It has fallen to 60. But if there is more demand, I think middle of the year there will be supplementary grants and this number will go up again. So these are just adjustments to what are market realities. So as the economy starts to normalize, I think it starts to happen. The second, on private sector capex, I think the private sector capex has been doing well. In fact, how much of it is pent up, meaning that during COVID for 1.5-2 years, companies were not spending because there was significant demand uncertainty. And there were also problems with finding access to critical chips or certain types of metals. The cost of constructing had also gone up. So the last, I would say, 6-9 months, we have seen very credible evidence that the industrial goods suppliers, like capital equipment suppliers, are consistently showing significant improvement in their order books. And very few of those are government projects. These are actually private sector projects. And if you see the reduction in India's capital expenditure ratio, like what they call in economic balance GFCF to GDP, gross fixed capital formation, which is the total investments happening in the economy as a percentage of GDP, the reason that fell was primarily because of real estate. That real estate investments from 2012 to 2020 and very likely to 2022 had actually been stagnant and in fact had declined as a percentage of GDP. So when those numbers come back, you will see that GFCF ratios start going up. Private corporate capex actually has been quite steady even during this process, during this period. And there is now evidence that those numbers are starting to go up. And some of the credit improvement that you've seen from the banks, you have seen announcements on new areas of investment, like green energy, green hydrogen. So some of those are longer duration. Some of them may even be pie in the sky projects, but those announcements have come through. There is significant interest in manufacturing in India. There are foreign companies looking at India as a base. So I don't think the government is spending and trying to crowd in investment. I must say that the government spending, especially central government spending, remember that the government does not have mandate beyond national highways and railways. I mean, they do have airports as well, but airports, while they're very important, and I'm glad that they're expanding, an airport is just a runway with a building, right? And it's not very capital intensive. It is the national highways, it is the railways. I personally think that from a 2 lakh odd crore capex in railways, perhaps we need to spend 6, 8, 10 lakh crores over a period of time. We need significant acceleration in railway capex. The problem has been absorptive capacity, in the sense that the railways have struggled to spend the money given to them. And now FY23 is the first year where the allocation initially given to them has been added to. So they've actually managed to finish their capex allocation, and so I think it's about capacity. It's like in national highways. I think we've discussed in the past as well.
Yep.
That back in '98 we couldn't even find contractors who could finish 100-kilometer, 200-kilometer stretches. Now we are doing 15,000 kilometers a year. We're doing 40, 50 kilometers a day, and the ambitions have gone up. Significant new expressways. So our capacity of the private sector to deliver at a very rapid pace, the ability of the government to finance these projects, to sell out of finished projects and start new ones, I think those are very important. And I think that we still need significant investments in roads and railways. So that will facilitate lower logistics costs and therefore support private sector capex from a global competitiveness perspective over the next 10 years. But the private sector capex is coming back.
Great. So, Neelkanth, private sector capex coming back. So, does that mean that capacities of private sector across sectors have gone up substantially over the last, say, year, 18 months?
Over the last year, definitely. So you would have seen in the Monetary Policy Committee statement today as well that as per the RBI's own Obicus survey, those numbers have actually gone up. So they're well above the median, so which means that there are several sectors where additional capacity is needed. And see, the era where you were suddenly adding 150% of steel capacity. Right? For example, 2006-07, I think we had 40-45 million tons of steel capacity. At one point, we were adding 50-60 million tons of steel capacity. Similarly, in power plants, I think we had 120-130 gigawatts of power capacity, and there was, I think, 100 plus gigawatts of power capacity under construction. So now that is partly what created the debt problems that occurred later on. So the pace at which you can do capex on, say, steel. Now, suppose steel demand is give or take 120 million tons now. If it is growing at 8%, you need 10 million tons of steel capacity every year. You don't need 60 million tons of steel capacity to be under construction. Maybe you need 30 million tons of steel capacity under construction. So that rara phase of aggressive capex, aggressive borrowing is something which perhaps is not sustainable. Yeah. But if the corporate capex as a percentage of GDP remains at this level, and I think that if we are able to get foreign capital to come in, and that I think is a big policy challenge, and which is something that I think the government is thinking about, needs to think about, and perhaps accelerate that process, is how do you get foreign companies to invest in India just for manufacturing? For example, we are envious of what Vietnam is doing in terms of its growth in exports. But remember that 70% or 2/3 of its exports are of foreign companies just bringing in the raw material, manufacturing in Vietnam, and then exporting. Even for China, 40-45%. So out of the $3 trillion of exports that they do, more than $1 trillion is foreigners manufacturing in China and then exporting out of China. Now, for that to happen, you need to really lay down the red carpet. And it's very exciting that so many state governments are doing that now. But equally importantly, we need to give them certainty on policy. For example, on taxation, that when a company uses India's shores just for manufacturing, what is the value addition, right? And what's the value addition on which they need to pay tax? And there will always be some uncertainty. I think foreign firms, because of some past disputes that we have seen, have been cautious in investing directly. If we can accelerate the process of signing advanced pricing agreements and some of those, maybe we can accelerate that. So I'm not saying that this is the best we can do, but I think accelerating beyond a certain pace also creates problems over the medium term.
Yeah. So one thing which as say private companies may not be as big, huge as it happened in the past in terms of say investments for increasing capacities dramatically. Does that? I wanted to take you to jobs in the sense that in the last 1.5 year we have seen that there has been general sense about lack of jobs, or say the government intervening in the jobs market by saying that there are 1 million jobs which are going to come up in the next 1 year. Even state governments making those promises. Maybe these are all poll related, may not be poll related. Maybe they sense that there is a demand for jobs or vacancies in government. Do you think that this jobs is a issue as the economy has slowed down? And do you think going ahead with private sector, as you say, with all signals that private sector would invest more in the coming years, is the job situation going to get better?
My own sense is that the job situation is already getting better. So there is a cyclical aspect to it and a structural aspect to it. So let me first run through the cyclical aspect. See, what happens when you lock people down is that the upper income households, which have a lot more of discretionary demand. Remember that in India, like in much of the rest of the world, the top 10% of the population consumes sometimes more than the bottom 50%, right? So there is a lot of discretionary demand, and a lot of that is services. So when you lock people down, your services consumption drops, right? So travel, tourism, restaurants, like private tuitions, coaching, lots of household services. Now, when you're purchasing those services, you're actually buying the time of the bottom half of the population. And when you lock people down, savings accumulate and deficits and debt accumulates here. So there is very strong distress in the bottom half of the population. Now, once you open up the economy, then it's almost like, water was accumulated here, a lot of savings were accumulated here, and they spend and they start to go down. And as that happens, jobs start getting created here in the bottom half of the population. So if there is an aggressive spending on eating out, on travel and tourism, if tier 3 towns are starting to see hotel rates in the 20,000-25,000 rupees a night, of course, at the peak of the market in December, it suggests that there will be more capacity addition, there will be more people hired, restaurants as they open, as traffic starts to become chaotic again, people start hiring private drivers. And we are starting to see, it's an anecdote, but sometimes anecdotes are very useful to communicate a trend. For the longest time, I would not get the newspaper on time, so I would complain that, look, if you don't give me the paper by 7:15, it's too late. I leave for office, I won't be able to read it. And he would say, boss, I don't have people. My people have not come back. These days, I get the newspaper at 6:45 because the people have started coming back. And so there are jobs. You can see that in the drop in the Rega demand, which suggests that I think the job market has started to normalize. How do we grow from here? And I think for that, some of that is just construction. So as the first step away from So that's a slightly more medium-term cyclical issue. I would even call it a structural issue, which is that if you have 40% of people in agriculture, the first step away from that is construction, because it is slightly less skill intensive. And if construction picks up, and which I think it is doing that, which is in real estate, which is mostly private market, and also the government spending on housing on roads and railways, I think construction jobs start to improve, and that creates I think some jobs. The real labor intensive stuff, which is about global manufacturing, like say in apparel, I think we need to do more. I think it is very disappointing what we have managed to do over the last 10, 12 years, which is that maybe even 15 years, that China has been ceding space, and all of that has gone to Bangladesh and Vietnam. And somehow our industry is unable to compete, because those are very, $1 billion is 7 lakh jobs. And there is another 80, $100 billion that China is yet to seed. And those are big opportunities. I think we are starting to do very well in mobile phone assembly, in technology assembly. I think the traction there is very good. So jobs, I think incrementally, the news flow is positive. Are we doing enough to create, 1.5, 2 crore jobs so that we can absorb the new people and also the shift away from agriculture? I think that is a tough ask. I don't think that's happening.
So the production linked incentive scheme seems to be one of the policy interventions which the government has been working on over the last couple of years. Except for mobile manufacturing, has it really worked in other sectors, like some of the high, say, job intensive sectors that you're talking about? Is it working in other sectors?
So the PLI schemes, first, I think they are a very important innovation in industrial policy. There are people who think that industrial policy itself doesn't work, but that's a very different conceptual debate. But if you have industrial policy, I think something like a PLI scheme is a very creative way to align the interests of the government and the private sector, which is that if you jump this high, then you get the incentive. If you don't jump that high, then sorry, I can't help you. And I think it's a very important innovation. You're absolutely right that in mobile phones it's working well. Just for the sake of clarity, in terms of numbers, the exports of mobile phones were like 45,000 crores in FY22, the last fiscal year. This year's numbers are, in a globally slowing mobile phone market, are likely to be 75 to 80,000 crores. And next year, they're likely to be 140,000 crores. So it's and perhaps more importantly, the supply chain shifts are starting to happen. Some of them, of course, are also policy driven, but quite a few suppliers are coming through. Like, for Apple's top 200 suppliers, in 2018, there were only 5 factories from India in that top 200 list. Even in 2021, there were 13, and I won't be surprised if there are substantially more when the 2022 list comes out. So the supply chain is starting to shift. It's very successful. I think IT hardware, I think the solar panels, the where the PLI scheme starts with silicon, creates the ingots, then the cells and the modules. I think that scheme will also do well. My sense is that out of the 14 schemes, I think about 6 or 7 will do well. There are 2 or 3 which are middling, and meaning that even if they were not there, I think the industry would still have spent. And there are 3 or 4 which I think are really struggling. I don't think they've been designed very well. So, like in any policy, there will be a mixed bag. It is an important signaling mechanism, because when you think about all the capex that will happen in PLI schemes over 4 to 5 years, maybe 7 years, the total number is only about $21 billion. And in an economy where gross fixed capital formation, that is total aggregate investment, is close to $1 trillion, I think $25 billion over 4-5 years is not that substantial. But given that foreign companies, foreign investors, everyone is talking about it, it actually is a very important signaling mechanism. that India wants manufacturing, that India is doing well in manufacturing. And I think that also is an important factor as we think about the role of these schemes. But there are several schemes, you're right. I mean, like the apparel scheme, there is very low traction. That's a sector which I think we need to get right, because it's very significant in terms of job creation, and there is so much space being ceded by China, and I do hope that we can get some policies right to shift a large part of that business to India.
So in this budget, one of the key highlights has been, of course, the government's focus on capex, which is heavy investment in productive sectors. And the other thing which really was an interesting idea was on raising the threshold income level to 7 lakh from rupees 5 lakh, in addition to the new tax regime which they talked about, the exemption free, making it, incentivizing it further by introducing standard deduction into the new tax system. How do you look at this at a time when we are just at a time when there are concerns about growth, there is huge global uncertainty, and India needs to grow domestically, because in terms of exports, you are going to face not a very easy environment outside.
Yeah, absolutely. So I think the problems that are created by slower exports are going to be very important. In fact, some of the recent slowing down that we are seeing in the economy, it can be directly attributed to that, in the sense that remember that we were stuck in a 250 to 330 billion dollar range if you looked at annual goods exports. So for 7-8 years we were stuck in that range, and then suddenly during COVID and the recovery after COVID, we shot up to about 445 450 billion dollars. This was a substantial improvement. It wasn't just because of global boom in exports, it was also India gaining share. But what happens now is that inventory levels in the US and a lot of other economies are very high, because they are now sort of regretting, I'm sure, that from the just in time to just in case kind of ordering, that they double, triple ordered, and because they were running short of inventory for 6 months, so they ordered excess, and now they're stuck with a lot of excess inventory. The aggregate demand at a global level is still at March 21 level. So for 2 years, there's been no growth in global demand and global goods demand. So as this starts to slow down, and remember that everyone has added capacity, there will be a 6 to 9 month period where there could be a significant weakness in global demand. And we could also see price correction. So because some part of this jump that we saw from 250, 330 range to 445, 450 was also pricing, right? The goods became expensive. Goods inflation globally was high. And as this starts to recede, I think that aggregate number could actually fall off. And I think as that happens, we need to sort of support it with domestic demand. And but in this context, I think the policy, the revision of slabs, the cost to the government of about 35,000 crores is a very small percentage of aggregate consumption. So I would not look at it as a consumption stimulus. Remember that next year's GDP is going to be 302 trillion rupees, or is likely to be 302 trillion rupees, 302 lakh crores. Sorry, 302 trillion is actually a simpler number. I think when you get into lakh crores, it becomes a bit complicated. And then consumption would be of the order of 180, 190 trillion rupees. 0.35 trillion rupees is 0.2% of that. So in terms of size, that's not how I would see it. I think some of these schemes are seen as giving relief to the taxpayer, bringing down the effective sort of tax rates, meaning that creating more incentives to get more people into the tax base, simplifying the process of tax filing, so you don't have to worry about whether you have HRA or don't have HRA. those kind of complications, and therefore the simpler it is, the more people fight tax returns. So that's how I would see this policy shift. I don't think it is required or this is large enough to actually support a lot of consumption. But I must say that the slowdown in exports, I think the point that you made is a very important one. I'm actually apprehensive that if Indian demand remains resilient, and I think it will, there is a fear, there is a possibility that global manufacturers would start sort of pushing their products into India. Remember that there's a lot of goods deflation happening, right? So PC processor prices have fallen by 20%. There has been a significant decline in DRAM prices, NAND prices, display prices, and devices will become cheaper. There are lots of goods that are starting to become cheaper. And as that happens, there is a fear that or we should be careful that there could be a lot of dumping that starts to happen in India. So the next year is going to be quite volatile in my view.
Yeah. Tell me something, in this budget, but one thing which we thought might happen, you can shed more light on this, was when there is a gentle nudge for people to move to the new tax regime because of the simplification and exemption free regime, and also some incentives there. Does products which are insurance based, which are always been sold in India as tax saving products, that may not happen, is what we anticipate, and probably in a culture which is more of a savings culture, India, it is it. Do you see any concern there? Because Indians really don't have that kind of a social security net, and without savings they could end up spending, etc., etc. But there were some concerns about that, people talking about it, so I thought I'll check with you.
No, I think it is about where those savings go, right? So if you see the decision tree or the stepwise decision process, you first have savings and then you decide what to do with it, right? So the first decision is whether to save or not. And once you've saved, then should you put it in a fixed deposit? Should you put it in a mutual fund? Should you put it in a equity mutual fund or bond fund
or a housing
insurance product, or buy a new house with it? Now, the fact that a tax arbitrage which was available, or it is too technical, but a similar thing happened with the market-linked debentures. So there was a product called the MLD, which would provide significant tax gains to people, and so that loophole has been sort of closed as well. So this is not a disincentive for saving. It is just making the savings flow into directions which are not distorted by tax loopholes, right? So just because for high income, remember that insurance tax loophole has been bridged for the large sized policy schemes, and so those large policies were generally taken by the rich, and which is, there's nothing wrong in being rich. What I'm just saying is that this was so they first saved and then allocated. So it is not a distance. It's not that if you close that, then suddenly they're starting to go and consume. So they will still save. Maybe they'll put it in a different asset class, and they will put it in a mutual fund, that's an equity mutual fund, or they will maybe add up and go buy a house. There are also criticisms that because the ATC deductions and also the basically the home loan, the interest that you pay, that being tax deductible is indirectly again a financing of a house purchase. And depending on the demand supply for houses, it can also be seen as actually financing the developer, because if you think about how the money flows, so the decision whether to buy a house or not, and is the net impact of that tax benefit is not as substantial. Though I must say that if you heard some of the clarifications from the government, the taxpayer can switch. Individual taxpayers can switch between old and new schemes every year if they want to, at least for now. So if someone does want to buy a house and get a mortgage, then and take advantage of that tax scheme, they can always switch back to the old tax scheme.
Yeah. And you think you said it in the beginning itself about the credibility of the numbers. You said the numbers look very credible. So what say if so much of the risk, if at all, or much of the concerns lie on the external front? Would you agree to that? Like, in the sense, is that so?
Yes, correct.
And how would you kind of look ahead? So what would be the three or four things which we should be mindful of?
So we've discussed the problem with exports, right? That, for example, a lot of the apparel companies which export in the last 3-4 months have already started talking about large-scale cancellation of orders. In fact, some of this started in June, July itself, actually July, August itself. And I hope that inventory correction does happen over the next 6 months, and in the second half of the coming year, we see slightly better momentum. But so weak exports is definitely one concern. The second is, as I said earlier, that if you are the only country, meaningful sized country with reasonable demand, and aggregate global demand is flat, you're the only one growing because of high product prices. Companies have added significant capacity. So then low price stuff starts coming into India, and that creates its own challenges. And raising import duties left, right, and center is generally not a solution to those things. So our manufacturers will have to become competitive, which will require a lot of pain, a lot of adjustment. I think that's the second problem. But a much bigger issue is capital inflows. So remember that we are a country which consumes more than it produces. And when I say consumes, that is consumption in aggregate, meaning it includes investment demand. So even if you're sort of investing, it actually adds to investment demand, aggregate demand. And so a country with a current account deficit is like a household which consumes more than it produces. Now, it needs a continuous source of capital, external capital, to finance that excess, that delta. And if there is an accident in the global financial market, so if there is a problem, suppose real estate prices globally have gone up. We had a period of 10-12 year period of extraordinarily low interest rates, and in fact, we now have. If you remember, there were several $1 trillion of negative yielding bonds, right? So if you bought those bonds, your returns were going to be negative. So that was the extent of monetary easing that had been done. Now, I think a month back was the first time in many years where negative yielding bonds just disappeared from the market. So interest rates have gone up. As interest rates go up, they can create new types of challenges. So, for example, if you have a sustained period of low interest rates, the capital structure, meaning if as a company, if I think I can afford 100 rupees of debt, if you halve the interest rates, I may think that I can afford 200 rupees of debt. And so if interest rates go too low, companies tend to add on to debt. The second thing that happens is that from the saver's perspective, so savers could be through mutual funds, through insurance funds, pension funds, individuals, because you're not getting enough interest rates and deposits, so you are going and buying lower quality bonds, meaning bonds and loans of companies that are less viable. Now, when suddenly interest rates go up, there is a problem that companies that have high levels of debt and are of poorer quality suddenly start having problems. A similar problem can emerge in real estate markets. So if you plot real estate prices globally, so they have a certain trajectory, but they're a bit volatile, but they tend to go up. But then suddenly around COVID, there is very sharp pickup. In most developed markets, real estate prices are 15-20% higher than they would have been if extraordinary monetary easing had not happened. Now, what if suddenly real estate prices in those markets fall by 15-20%? What if the Chinese real estate market, the tier 3 cities, there is excessive development. Those are cities where population has declined by 2%. And remember that real estate construction in China is 15% of GDP. And if that weakens, and a large part of Asia, which was driving global growth, there's suddenly no global growth at all. And then what happens to commodity prices, which indirectly will help us to some extent, but what happens to our exporters? What happens to the aggregate pricing, and then debt sustainability for some of the local companies? So there are many types of risks that I think can emerge. And once that happens, if one large financial firm fails, right? So some real estate investment trust, which is over leveraged, just fails. India would suddenly be locked out of capital, because when there is de-risking and there's an accident, you have a very sharp drop in capital availability, and then India needs to slow down. So I think the risks are through weaker exports, possibility of imports surging because global manufacturers start using India as a dumping yard, and a sudden slowdown in capital availability for the Indian economy, which then slows down the economy very sharply. So all of those are risks as we go into the next year.
Yeah. Neelkanth, I'm leaving one question, very important question for the audience to ask. But before I move to the audience, let me ask you this: how do you look at the rural India picture now? Say post-COVID, this is the third year, 2020, 21, 22, and now 23. We are heading into March. Do you see signs of stress in the rural economy? Do you think they will add to growth this year going forward? Do you see anything in the budget for which is directed at the rural consumers?
So when you the first thing is that this urban-rural divide is a dynamic one, right? And more so when you think about how some companies also actually consider some class A villages with more than 20,000 people as urban. There are car companies which think that any city beyond the top 100 is rural. So this is a very diffuse definition. A lot of the rural areas, and you do a lot of field visits, you must have seen. I mean, everyone has pakka houses, electricity is available. So I think this urban-rural divide is something that is very diffuse now, and I find it analytically very, very challenging to think through it. What I find useful is upper income versus lower income, and as I said, I see that finally that with the upper income consumption accelerating, that rural, or rather the lower income jobs have actually started to come back. So there is some revival. The second axis around which we can think about this is agricultural versus non-agricultural, because 94%, 95% of agriculture is rural. So though we have to remember that agriculture is only about 30-32% of rural GDP now. So in agriculture, the simple terms of trade are: if food prices are strong, there is more money that is going into the rural areas, and vice versa. And so far, the food prices, the inflation is quite reasonable. It was actually high; it has now come down a bit, but it is still reasonable. Global, prices, now there is a lot of increase, as your colleague Harish has been writing as well. Milk prices have started to go up, and so there is some shortfall on the volume side. That's more than made up by the higher prices. And remember that milk is a much bigger contributor to the value of output in agriculture. So all in all, I think this flow is quite steady. There is a lot of remittance income. Unfortunately, we don't have reliable data to track it on a regular basis. And what I mean by remittance is not remittance that's from the Gulf or the US or Australia. I'm talking about workers staying away from their families and transmitting money every month. So as the urban areas have seen more jobs, and as more construction picks up, I think there will be more such jobs. They start sending money back home, and that also supports the rural economy. So I think that the lower income households have struggled during COVID and in the year and a half after COVID. I think their balance sheets, meaning they have, because they still had to survive those tough periods, they've had to shed assets, they've taken more loans. It'll take them several years to come back to normal, but incrementally, I think that situation is improving.
Yeah. I'm throwing the floor open to the audience. May I request Sonam Sahu of Plutus IAS to ask her question?
Good evening, sir. I'm Sonam, Senior Counselor at Plutus IAS. Here where my question is, why import duties drastically altered in both budgets? We saw an increase in the 2022 to 23 budget and a decrease in the 2023 to 24 budget. That's all.
So, see, the import duties on various goods. So, I mean, even last year, so the categories and the HS codes along which import duties were moved up or down. So, there are several decisions. There are several factors that go into those decisions. I'm not privy to all of them. Some of them, in fact, conceptually, I would disagree with. But there are, for example, there is a time when India is trying to do import substitution, say in mobile phones. Now, this, of course, we crossed this bridge a while back. When you're doing that, the policymakers may think that reducing or increasing the import duties will actually incentivize companies to set up manufacturing in India. Now, once India becomes an exporter, so as I said earlier, India is now a big exporter of mobile phones. Then you are actually competing against Vietnam and Mexico and China, and there the import duties that you have on mobile phone components, for example, actually become a differentiating factor. So then you may want to bring down those duties. So these are decisions which tend to be quite dynamic. I think that, if the underlying philosophy in your question was why should import duties be so volatile, I think in principle I'm in total agreement that I think giving certainty of duties is very important for attracting foreign manufacturers or even for domestic manufacturers.
May I request Arun Agarwal, who's a director with Kotak Mahindra General Insurance Company, to ask his question?
Good evening, Mr. Mishra. Thank you so much for today's conversation. My question to you is in the context of India's growth and developmental trajectory from what it was in the last 75 years to what it wants to be in the next 25 years. When we're talking about Amrit Kal, start of the Amrit Kal, and we're talking to be amongst the developed nations. Therefore, I just thought I might ask you that why can't we have a different approach to macroeconomics? In the sense that can we have a macroeconomic vision straight away coming from the Prime Minister of the country, from the Chief Executive of the country? And therefore, once you have the macroeconomic vision coming through, it will then get into the microeconomics that we're talking about. And given the fact that we now have big data availability, we now have the behavioral economics, changes happening, or the infrastructure being laid out. Do you think that this approach might be better to be able to explain the sheer concepts of and principle of economics to everyone, including the to the general population?
See, the Indian economy is a very complex place, a complex system. Remember that we are a sixth of the global population, and it has many stakeholders. All of them are quite, they have their self-interest, they have their own powers. State governments control land, labor, environment, health, education. If you want to really transform those sectors, it is best done at a It is best done at the state level. I think from the central government's perspective, the direction, the vision that look, if we need to really pull people out of poverty, if we need to grow, India as a country needs to grow rich before it becomes old. We have about 30 years to grow. I don't think 7% real growth is going to be sufficient. We need to grow faster than that. The fact that I think the Prime Minister asks all state governments, I mean, he's now organized several conferences of chief secretaries to work with them on better managing urbanization. So the question is, how many cities you need metro rail? How do you manage the urban infrastructure? Because urbanization is going to be an inevitable part of this expansion process. So there will be, I think, multiple stakeholders. I think a top-down mandate is sometimes not very productive, though I think a top-down vision is definitely useful. It charges up, galvanizes people. When you talk about macroeconomic vision, just remember that macroeconomics encompasses a very large number of variables, in the sense that what should be your exchange rate, what should be your desired, what is the current account balance that you would like to have, what amount of capital flows will you need, what nature of those capital flows will you need, and all of those are need to be calibrated on a not on a maybe 3-month, 6-month basis, but every few years, because the availability of foreign capital, the nature of foreign capital, the terms of trade that India faces, right? For example, we have a very large current account deficit because we import a large part of our energy needs. What if energy becomes very cheap? Or conversely, what if energy becomes very expensive? Then we will need a lot more of foreign capital to finance our growth, because you can't grow GDP without growing energy. So these are, I don't think it is prudent, and I think the leadership understands that, to actually set very hard parameters around which, other than the growth aspiration that we need to grow and think about 25 years, and then think about what we will need for those 25 years, what kind of social safety, social security schemes we need, what kind of education we need, what kind of health we need, what kind of infrastructure we need. So that's the way to think about
it. Thank you, Neelkanth. May I request Alok Kumar, who's a PhD scholar with IIT Bombay, your alma mater? No, yours is IIT Kanpur, right, Neelkanth? Sorry. Alok Kumar?
Alok, we can't hear you. He's here. He's not able to.
I'll go to the next person.
Yeah.
Alok can come in later.
Yes, sir.
Yeah. May I request Suresh Sharma, who's a senior director and campus head at ICFAI Business School?
Let me also unmute myself. I hope I have successfully unmuted myself.
Yeah.
Yes.
Oh, great. Dr. Saab, it was very nice for you to have come on this forum, and we have all benefited from your analysis. I have one or two questions, sir. Sometime I was trying to see how best can I condense them, you see. Dr. Saab, on the one side, if you take the savings behavior of Indian economy, we have been continuously declining in terms of savings to GDP ratio. It used to be 37, 38% at one time. It has come down to 27, 28%. And then we are saying that we are trying to make up this decline through inviting the foreign capital, and the risks involved in depending on the foreign capital you have beautifully brought out during your analysis. So where are we going? To me, it looks as if the whole atmosphere, Likewise, you take the case of tax collections. We used to say that once GST comes, inflation will become a thing of past, you see. And once GST comes, collections will be so high. It is true, collections have gone up to almost 1.5 lakh crore rupees a month almost. That's why, and then we used to say, as far as direct taxes are concerned, we will have efficiency ratios going up. We will plug leakages, and technology will help us in chasing and ensuring that nobody is able to avoid the collections will be quite significantly up, All this has happened. But still, your dependence on deficit financing or fiscal deficit, particularly primary deficit, actually is disastrous. Our record is disastrous. We are depending upon primary deficit in such a big way today that even what we have achieved in the earlier years of 2001-2, the idea used to be FRBM Act, that primary deficit must be brought down to zero level. It has reached almost 5% level, sir. So that's basically, and quality of expenditure you mentioned. We'll be very happy if you can enlighten us whether the quality of expenditure in the central government is in any way better than what it is in the state government, because state governments are also going in for the budgetary deficit, etc., to the extent of maybe 4 to 5% of GDP. So put together, the deficit is coming to maybe 11 to 12%. And that is becoming the cause of inflation. And it is not only the imported inflation through your supply chain management disruptions, etc., etc. I know, sir, I may look to be a little confused, but I am not confused at all. The point I am making is what kind of fiscal balances we have been able to achieve, what kind of promises that we have made with the introduction of technology in terms of tax collections, etc., which will lead to reduction in budgetary deficit.
Thank you.
Over to you.
Yeah.
No, thank you. So there were quite a few questions and well, actually quite a few observations, interesting ones. Some I'm not sure sort of reconciles well to the data that I see. But I was able to glean some questions in there, and let me try to answer them. So I think on the savings ratio, I must say that I think financial savings, the percentages at a gross level are not as bad as perhaps you made them sound. So at a net level, yes, because what is starting to happen is that that household borrowing levels have gone up, and while that is criticized as somehow a debt-driven culture, that people are borrowing to eat and the small ticket loans, those are very small in my view. One of the reasons that household debt has actually gone up is because the informal sector, which was earlier shut out of the formal borrowing system, is now starting to get some credit. Now, some of it could be ECLGS, some of it could be very simply the rise of account aggregator models, more data, new non-banking finance companies which know how to lend to small ticket loans and etc. So I think the gross financial borrowing numbers, gross financial saving numbers are actually not that discouraging. In fact, there seems to be very healthy flow of savings. On the tax to GDP, but yeah, so the question was if savings, domestic savings can be brought up, can we actually sort of do away with foreign capital? I wouldn't look at it like that, right? Because remember that if you're saving too much, your domestic demand goes down. One of the reasons why a lot of foreign capital and a lot of foreign investors are looking at India is that there is a lot of stability coming from domestic demand. Now, if you still want to grow faster and you want to, retain, because if you slow down and you are then completely dependent on external demand for your manufacturing, that's even more dangerous and lopsided. So having a slight amount of current account deficit which means that you invest and consume slightly more than what you're producing, and then you finance it with foreign capital, with multinationals using your shores for manufacturing for the rest of the world because you have a lot of cheap labor, your infrastructure is improving. I think that is a slightly more sustainable and credible model. And so I would not see it as a disadvantage. I would rather see it as a necessary. It's like, I bought my house when I was in the mid 30s. My father bought his house close to his retirement because he refused to take credit. And I was willing to live with a home loan for a few years. So I think that's the similarity, that if you want to grow fast, given that you have 30 years, you need to accelerate your growth. On domestic savings, you can grow at 5-6%. If you take foreign funds, you can grow at 8-9%. Tax to GDP has actually gone up. If you see, GST collections as a percentage of GDP, this ratio was 6.2, 6.3% pre-COVID. It's now closer to 7%. Direct tax collection as well. The ratios are now closer to what they were at the peak in 2008. So on the taxes where there has been some reform, like cutting of the corporate tax rate or just the introduction of GST. And remember that in GST, the government is just about starting to process and analyze that data and start to close the loopholes. So for example, as the government has recently announced as well, that the existing taxpayers in GST, average tax paid is about 4 lakh rupees per year. The new joiners are paying 1.1 lakh rupees. So there's been a significant widening of the tax base, which I think is very important. And therefore, I think the tax to GDP situation is definitely improving. Having said that, I think a debt to GDP ratio of above 80% of GDP is very dangerous, because it means that while the whole world has seen sovereign debt to GDP go up, we need not think of that itself as enough reason to be very happy about it. It is an elevated number. It needs to be brought down, and you're absolutely right that it needs to be brought down by a reduction in the primary deficit. Primary deficit is not 5%; it's closer to 3%, but it is still too high, right? And it should be 0.5% or 0% if debt to GDP has to shrink. But remember, as I said right upfront in this conversation, the biggest challenge for the finance ministry is the pace at which you consolidate. Remember that debt to GDP, India cannot be brought down by shrinking into it. What I mean is, if you try to bring down fiscal deficits very aggressively by reducing your borrowing, and then thus reduce your borrowing, you can actually slow the economy down. So in debt to GDP, there are two ratios. Right? There's a debt divided by GDP. The best way to shrink the debt to GDP ratio is to grow the denominator, the nominal GDP. And if you slow down the fiscal deficit or bring down the fiscal deficit too aggressively, you end up actually creating a very perverse spiral. So it is a very finely calibrated process. And I think this is a process which will take another 5-7 years, where you slowly bring down fiscal deficit, you keep improving the quality of expenditure, you try to support the economy. So as the private sector takes up the cudgel, the government slowly shrinks its footprint. And over a period of time, then this becomes much more sustainable. The 70% that we had going into COVID, I think it will be 2030 before we can even attempt, 2032 maybe, before we can even attempt to get to that level. So it's a sustained process of consolidation that is ahead of us. And I do hope that the governments that come to power or are in power in the next 7 years or 10 years can sustain that discipline.
Thank you, Neelkanth. We have a student from Miranda House, Kirti Kumar.
Yeah, hi. So my question to you, sir, was that the outlay for the seventh gender budget constitutes around 21%. And there has been almost an increase of 0.22%. So in your opinion, how is the government progressing when it comes to gender budgeting in India?
See, the budget allocations, I think, are a very small part of the agenda of the government. So if you think about one of the biggest challenges we have in the economy, it is in the female labor force participation rate, which in India is very low. There are measurement issues. So I'm told that the 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 criteria India uses for classifying someone as in the labor force or not is different from what other economies do, and therefore it's not like apples to apples comparison. But still, whatever you say, that ratio has been dropping, and it is low. Right? It could be higher than what the current number is, but it is low. Now, how do you increase that? How do you improve that? And so instead of just looking at specific gender allocations, think about the increase in allocations for the pipe water scheme. How do you get women to come to work? You have to first save them time. If they're spending, walking 5 kilometers to fetch water, and then if you've thought through how much time it takes without, running water to wash utensils or wash clothes or even brush your teeth or in my case, even to shave, it's very time consuming, and running water is very important. And Vadi thankfully doesn't have that problem. So the thing is, if you solve for that problem, if you solve for the dense energy problem, right? In 2011, 2/3 of Indian households used primitive forms of fuel, which meant cow dung cakes, firewood, uh, uh, crop residue. The girl of the household would be going into going out just collecting firewood. And if you've seen how mud stoves and firewood work, one, it's a very slow process of cooking. You need to put these layers of mud on the stove, on the utensils. It needs heavy amount of scrubbing to get rid of that over time. If you replace that with electric induction cooktops or LPG cylinders, it saves a lot of time. If you get women into the or if you look at girls enrollment up to standard 6, it has improved dramatically. I think now we need to improve the education quality. So those, I think, are far more important from the perspective of improving our FLFPR than the gender budget allocations, which I think is important, but that's a small allocation. Even if it was bumped up by 20%, I don't think it make much difference. Sorry,
Sorry, I was on mute. We have another student, Sakshi Singh from Stephens.
Am I audible?
Yeah,
Yes.
you're audible, Sakshi. Thanks.
Good evening, sir. Thank you so much for this enlightening session. My question is regarding India's goal to become a $5 trillion economy. So IMF projections say that that earlier projections were that we will achieve this target by 2029, but they revised it and said that India will be able to achieve this by 2027. But there has been recent optimism due to India's high GDP growth rate that we will be able to achieve this by 2025. However, there has been serious concerns about certain setbacks in our economy, as you mentioned, that low labor force participation rate. So there are certain bottlenecks that can set back our attainment of this goal. So, in your opinion, what do you think? Like, which two sectors will be the most important to aid us in reaching this $5 trillion economy goal amidst the lurking global recession? Because that will affect our exports. So, which two sectors should India seriously focus on to achieve this $5 trillion economy goal?
No, I think the most important has to be housing. Remember that housing is in the roti kapda makan sense one of the basic necessities. It is completely domestic demand, and it is a very large quantum. So if you think about, well, you're still a student, but if I think about my household spending on, say, clothes or food, and I multiply that by 30 years, that amount is still a lot smaller than the amount I paid for my house. And so it is one of the biggest purchases households make in their lifetime. And so if you can get real estate construction going in a big way, it is reviving. There is a market, as I said, after almost a decade-long slump, we are starting to see revival, which is what keeps me optimistic on growth. But the challenge is going to be making it a volume-driven recovery instead of a price-driven recovery, in the sense that if we can accelerate the process of clearance, we can accelerate the process of construction and meet demand on time, then we can see much more construction activity happening instead of just price growth in real estate. It then becomes very speculative, and then quickly houses become unaffordable, and then the whole market slows down again. So I think it's important for state governments, municipal governments to look at the real estate sector very constructively. I think the second important factor, as I said, is earlier as well, is apparel, because this is a market where we can meet global demand. Again, apparel demand is remarkably steady. People buy a certain number of clothes. Some people, I think, buy too many clothes, but I think that of course can't be helped. But the point is, this is external demand that we can meet. We have the labor, we have the skills. I mean, we have dominated this sector for hundreds of years, and it's a conundrum for me as to why we are not able to take up the slack that is being left by China receding from this market as they run out of workers. So I think both of these, I would say, construction and apparel production, are among the most labor intensive of sectors, which are very important for job creation. From growth in aggregate, I think that there are reforms that are required on the energy side. We need to make energy use much more efficient. If we can improve our energy efficiency, remember that Japan generates $4 of GDP per unit of energy if we generate $1. And if we are dependent on external energy, it is very important for us to improve energy efficiency as well. So those would be the critical challenges.
Sorry, Neelkanth. I think I had my laptop logged me out. So, but
Okay.
yeah. So there was a very interesting observation which Dorab Sobariwala had made. I was just reading through the chat box, and he talked about, I'm not remembering the numbers because my laptop shut down, but he was saying about, how the kind of jobs which, $1 million of investment in a textile company creates vis-a-vis, say, a refinery, or probably RIL creates for $1 million investment, and quite a sharp difference.
Yes,
So
totally.
his question was essentially what you had referred to in your thing about capital intensive or labor intensive industries. So for labor intensive industries, what is it that the government has done, which you did refer to while we are saying that textiles is one area where we could do much more with huge employment. So do you specifically want to kind of reflect on this, Neelkanth?
No, I know this is a budget discussion, but remember that the budget is a statement of accounts of the government of India, right? And we have to remember that 85-90%, if not more, of the government's expenditure is committed.
Yeah.
So every year, nearly a fourth, so 23 to 25%, goes into interest payments. Then
Yeah.
there is salary, there is pension, there is defense expenditure, which I think is absolutely critical.
Yeah.
There are essential subsidies. So you cannot wish away, and I think it is very essential that we spend on the PDS and support on subsidized food.
Yeah.
So once you add up all of this, the amount of discretion available for the central government, I think, comes down to maybe 3 lakh crores, which is like 1% of GDP. And to expect that itself will do all the transformation in the economy is perhaps asking for too much. So you're right that I think a lot more needs to be done for labor intensive industries. and perhaps they can be done by state governments by reviving and accelerating real estate investment, because construction can create a very large number of jobs, and reviving that construction, and the fact that many of the states themselves have been struggling to spend is actually been a headwind to growth, meaning it has slowed our growth down. So the heartening point is, and as one of your colleagues has also mentioned in the Express in recent weeks, I think a week back or so, where she wrote about how state capex has actually started to accelerate. And uh, so it's after a long lull, right? Because they were struggling during COVID to even keep the offices running. So as the state starts spending, I think job creation, etc., can start to come through. It would be too much to ask for all the problems of India to be solved in 3 lakh crores.
Yeah. Thank you so much, Neelkanth. I think there are so many questions that this can continue for another 3 hours, but I think we have to kind of wrap up for bringing out the edition tomorrow. Thank you for your time so much, and let me also thank our partners in this, Plutus IAS. Thank you, audience, for being with us for this very enlightening session. Thank you.
Thank you, Belly. Thank you, everyone.
Plutus IS will be starting new batches for UPSC CSE 2023-2024 from 1st February. Our features are live interactive classes, limited batch size, well qualified and experienced faculties, doubt removal sessions, current affair classes, study material and test series, mentorship program, mock interviews. To know more, contact us at 844-844-0231 or visit our website www.plutusis.com. Plutus IS will be starting new batches for UPSC CSE 2023-2024 from 1st February. Our features are live interactive classes, limited batch size, well qualified and experienced faculties, doubt removal sessions, current affair classes, study material and test series, mentorship program, mock interviews. To know more, contact us at 844-844-0231 or visit our website www.plutusis.com.